Welcome to a video that I like to call the deep dive video. This is the last video that I do each week. I do a video every day, also a weekly video, an intermarket analysis video, and then I go back and I look at all the daily charts, and those that I didn't cover in the past week, I bring those up in this video. This is not necessarily meant to be a standalone video. If you're just watching this, you're missing a lot of the other analysis and commentary that I do. This is just to kind of add on to that. Think of this video as being an addendum. It's being prepared for Monday, June 12th. Incidentally, I may have solved the issue that I was having over the weekend with my regular computer. That's what I'm using right now. I'm going to try to also not do as much editing to get this posted as soon as possible. I will trip over my words a little bit. I may lose my train of thought. There may be some pauses. The idea is to get these videos ready and upload it as soon as possible. The first chart that we look at here is a chart of the VIX, and I pretty much show this in every deep dive video. You don't see the VIX on this chart. It's on here, but then I turned it invisible. What we have on top of that is a 50-period exponential moving average, and this gives us a range over a period of time. If you look over on the right-hand side, we have been in a range between 27 and 28 to the upside. That's when the market's going down, but we've been really falling overall. And we're seeing a lot of our other indications that the VIX is falling lower over a period of time, which might suggest a little change in the overall picture. This is the VIX, and then we do a ratio with a 3-month average of the VIX. The line I pay attention to the most is the red line, and this is also declining, meaning that there's not much fear. Here we have the VIX to a ratio of the VVIX, or the VIX of the VIX, also shows a decline overall, meaning that there's not a lot of fear in the market. I had been showing this a little bit previously, but this is a VIX to S&P 500 correlation. When this starts to really go up and get above this dashed line, something strange is kind of happening. When we were going up a few days ago, I did bring this up in the daily videos, but now we've been dropping back down. So we're watching this chart, but at the same time, it's not really telling us much right now. Then we have the equity put call ratio. This seems to be the last chart that's updated. I'll get the 5-period and I'll get the longer term chart. That's updated right away. But to get the daily version of this chart, it seems to come in way late. And sometimes I've thought it was saying something when actually it wasn't. Well, we actually have fallen in the most recent couple of days. Here's the 5-period moving average, which seems to update quicker. And it's also going down, and then you have a longer term version of this chart, and that's what I've been showing in the daily videos. I've changed this a little bit too. Where are we since we hit the all-time high? That was in early January of 2022, and then I just draw a line down here to where we're at now. We're down 10.79% from that all-time high. This is just kind of an informational chart where we've been above and below 4,000 a number of times, just to kind of keep an eye on this. The technical alerts are put up by stockcharts.com. These are just for Friday's session. We had an up open anyway, so a lot of the new signals that were generated were blue. If they're negative, they're red, where the S&P was able to get above 4,300, but we closed below that. And then the NASDAQ was able to get above 13.3. The tech sector was able to go above 70 with the BPI. It set a new 52-week high in the NASDAQ, and the volatility index, or the VIX, has set a 3-year low. Then we take the different indexes that we look at, the Dow, the S&P, the NASDAQ 100, the small caps, and the mid caps, and we rate them on a score of 0 to 100. The higher the score, the better looking the chart. Well, coming in again this week at number 1 are the QQQs, which is the NASDAQ 100, and they're giving us a score of 97.7. In second place is the S&P at 86.3. Third place are the small caps. They had some really strong days earlier in the week. They're at 59.4. The mid caps come in at 57. And then in last place right now is the Dow. It's been more or less chopping sideways. Some short-term charts that I didn't cover in the daily videos. This is a rainbow chart going from 10 periods up to 50, where we're above all the plotted moving averages. If we can stay above this rainbow will start to smooth out. Then we have a 20-period double and triple exponential moving averages. Sometimes I show this when we're coming back down to either the blue line or the green line, well, we're still well above that. Then here's a regular 20-period simple and exponential moving average. I haven't been showing this because we're far away from that right now. If we start to turn and come back down, this is one of the initial lines of support that we look at. Intermediate term, also another rainbow chart going from 50 periods up to 100, well above all of the moving averages, and the rainbow is starting to smooth out. Then we look at the Connors RSI, which is another momentum oscillator. We look for extreme positive or negative readings. When we're above the dashed line and going up, that's positive. Below the dashed line and going down, that's negative. Right now, we're more positive. And then here's a 50-period double and triple exponential moving average, and we're above both of these. And then we have an anchored moving average going back to the all-time high, which I'll show again here. I haven't been showing the moving average tree because we're well above all of the plotted moving averages. Then we have a 50-day cycle that for the last year or so seems to be kind of helping. There are times when this marked a low or some kind of a turn in the market. Other times we hit that 50-day period and just kept going in that same general direction. We had the end of a cycle on May 19th. We came down a little bit. We thought, okay, are things starting to shift? But now we've been starting to go back up. The next cycle will end on August 1st. That's what this next red line is. Then I take a 20-period simple moving average of the open, high, low, close. Sometimes these can provide either support or resistance. We're well above all of them, so I haven't been including that. Then here's the other anchored moving average going back to the all-time high. If we fall, that may provide some support, but since we're far away from that, I haven't been including it. Then we have how far are we above or below the 200-day simple moving average. When we're green, that's above. When we're red, that's below, and we are showing improvement. Here's a 50-period moving average study. We're well above both the simple and exponential moving averages, and a 100-period simple and exponential moving average that we're far above. The mass index, we're not getting a signal from that right now. When this line goes up to the dashed red line or to the blue line, that's when a potential signal can happen. Then we look at the stocks above their 50-period moving average. We have been watching a bigger study that takes all of them together. This breaks it down. This will be the S&P, then I'll have the mid caps and the small caps. When we're above 50 and advancing, that's more positive, and we're that way right now. We use this like an oscillator when we get an extreme positive or negative reading, and we're just about in the middle. Here are the mid caps also showing a little bit of improvement and above 50, and the small caps also improving and above 50. Then we look at a 10-day average of the highs minus the lows in the S&P 500. Also use this like an oscillator. When we're above 50 and advancing, that's positive. When we get up here above 90, that means we're extreme positive. But you can see in the past, when the market's really strong, we can stay up in this area for a while. Then when we drop, usually we don't see it camped out at the lower levels. We did back in 2009, but that was a really difficult time for the market. Sometimes this can help us to determine when the market's exhausted after it's been going up or ready for a bounce when it's been going down. And we look at standard deviation. As the S&P has been breaking out of the range that it's been in, we saw this start to go back up. Now we're chopping sideways, so the standard deviation is starting to come back down. Ichimoku cloud. We use this for support or resistance. When we're below it and coming up, it may be resistance. When we're above it and coming down, that may be support. We also take note of the different changes in color. All this is a moving average of what's already happened, and then you shift it forward. A lot of people like to use this for that. There are other tools that we can also use, but since so many people use this, this can often be a self-fulfilling prophecy. Some long-term charts. Here's another rainbow chart going from 50 periods up to 250 periods. This is a little smoother because these moving averages move slower, and we're well above all of them and looking more positive. Then we have the percent of stocks above their 200-day moving average. We're above 50 and advancing. That's more positive. We can also use this like an overbought or oversold indicator. Some broad market things. We have the Vixen, which is the VIX of the S&P 500. I ignore the top chart. I look at the line chart, and fear is pretty much non-existent in the NASDAQ 100. Then we've been keeping an eye on this too. Since the big companies are really outperforming the smaller companies, the S&P 100 is on the bottom. Where it's been going up, we've been more or less flat with the S&P 500, just showing that the big companies are outperforming. Then we take the really small stocks, the microcap index. I really only pay attention to this chart when we get back down to 100. We dropped below that earlier in the year and set a new 52-week low. So far, we've been bouncing up, even though the overall index is in a downtrend. Then here's a longer-term chart of the QQQs, longer meaning a weekly chart. We're well above the anchored moving average going back to the all-time high. And since we're so far away, I haven't been including that. Some rate of change charts just to get a real long-term perspective, 250 periods looking back. We are showing some improvement on this chart. This is also a 250 period chart, but longer term, going back to 1980, and we're above zero and advancing. So longer term, the market is starting to show some improvement. Bonds. We just keep an eye on the euro dollar. That's a good proxy for the Fed funds rate, and it's typically below the 2-year yield. Sometimes they get kind of close to each other, but right now they're maintaining some space. We just want to see what the overall direction is with this chart. And then here's our yield curves. We have the 10 to the 2 and the 10 to the 3 month, which are inverted. The 30 to the 5 is now dropped below zero, so it's now inverted again. The 10 to the 5 is also dropping below. So all the plotted charts that we look at have the yield curves remaining inverted. On the bottom is the Fed funds rate, and since that doesn't update as often, I don't use that as much. Then we look at the 1-month yield, which should be lower than the 3-month yield. The longer you hold on to something, the higher the interest rate should be. Typically, we'll see the red line above the blue line. Well, back a few weeks ago, we actually saw the blue line crossing above, but then it came back down, and they're acting more normal right now. So thank you. I hope you found this helpful. Please feel free to check out all the other videos that I post. Have a wonderful week, and I will talk to you in the next video.